Hello and welcome back to the Financial Freedom Show. In today's video, we're going to be talking about my future plans for my joint account, which is my taxable brokerage account, and what I'm planning on buying in that portfolio. And without further ado, let's get started. So today we're going to be talking about a very different type of ETF, one that doesn't focus on stocks, dividends, or growth, but rather on government bonds. So if you're looking to diversify your portfolio or potentially hedge against market volatility, the iShares 20 plus year Treasury Bond ETF, ticker symbol TLT, is something you'll want to know about. So we're actually going to dive deep into what makes TLT tick, its role in the market, and how you can use it in your portfolio. So I'm planning on actually transferring my money that is in SPAXX into TLT. So basically, as interest rates are coming down, TLT's price will go up and SPAXX will actually remain fixed. So this is a rather large part of my portfolio, so if it actually increases, then I'll be able to maximize my returns over the long run by just investing in TLT. So if it goes from its current price of around $100 to $170, I'd make about $7,000 from my $10,000 that I'm going to put into TLT. So that's my plans with this portfolio. We're going to take a look at what TLT is and how it works. So first, let's talk about what TLT is. The iShares 20 plus year Treasury Bond ETF is designed to track the performance of U.S. Treasury bonds with maturities of 20 years or more. It was launched in July of 2002, and TLT gives investors exposure to long-term U.S. government bonds, which are generally considered one of the safest investments out there just because they're backed by the full faith and credit of the U.S. government. By investing in TLT, you're essentially loaning money to the U.S. government for a long period of time, at least 20 years, while collecting interest payments along the way. This ETF holds bonds with an average duration of around 17 to 18 years, which is why its price movements are very sensitive to changes in interest rates. So how does TLT actually work? The ETF holds a portfolio of long-term U.S. Treasury bonds with maturities ranging from 20 to 30 years. These bonds pay a fixed interest rate known as a coupon, which is then distributed to TLT shareholders in the form of monthly dividends. Now here's the catch. TLT's price is actually highly sensitive to interest rate changes. So when the market interest rates go up, the value of the bonds in the fund go down. And when interest rates fall, the bonds appreciate in value. So this is because investors would rather own newly issued bonds with higher yields than older bonds that have lower yields. That sensitivity to interest rates is known as duration risk, which makes TLT an interesting tool for investors who want exposure to the bond market, but also means that it can be quite volatile when rates are changing. So why might you consider TLT for your portfolio? One of the main reasons to consider TLT is for portfolio diversification. Treasury bonds have historically had a low or even negative correlation with stocks, meaning that when stock markets are in turmoil, U.S. Treasury bonds often rise in value. This makes TLT a popular choice for investors looking to hedge their stock exposure. I personally have a lot of stock exposure, so having TLT in my portfolio is a great way to hedge against any market downturns. Another reason to hold TLT is for the income. Although the yields on long-term Treasury bonds have been low in recent years, TLT still provides a steady stream of monthly interest payments, which can be appealing for income-focused investors or retirees. And finally, TLT is a way to express a view on interest rates. If you think interest rates are going to fall in the near future, buying TLT could be a smart move since lower interest rates tend to push up the price of long-term bonds. That's what I believe. I believe interest rates are going to come down in the near future, so that's why I'm considering buying TLT before it goes up in value too much. Of course, no investment is without its risks, and TLT has its share. The primary risk here is interest rate risk or duration risk. Because TLT holds long-term bonds, it's extremely sensitive to interest rate changes. So if rates go up, like we've seen with the Federal Reserve hikes the last couple years, the value of TLT will likely decline. Another risk to consider is inflation. Treasury bonds pay a fixed rate of interest, so if inflation rises, the purchasing power of those interest payments decreases. Long-term bonds are especially vulnerable to inflationary pressures, which is something to keep in mind if you're worried about rising prices. And lastly, there's opportunity cost. In a rising interest rate environment, investors might prefer to hold shorter-term bonds or other investments that offer higher returns with less sensitivity to rate changes. This could make holding TLT less attractive during periods of economic growth and rising inflation. So, how can you use TLT in your portfolio? For many investors, TLT can act as a hedge against stock market volatility. When equities drop, long-term treasuries tend to do very well, providing a counterbalance to falling stock prices. This can help smooth out your overall portfolio performance. TLT can also serve as a strategic bet on falling interest rates. If you believe the Federal Reserve will lower interest rates in the future, TLT could offer both price appreciation and a steady income stream. However, keep in mind that timing interest rate moves can be challenging. So I'm going to consider buying TLT in my joint account, my taxable account, instead of SPAXX. TLT can be a great option for conservative investors looking for safety and income. While the returns from TLT are not guaranteed to beat inflation over the long run, its monthly income and stability can be attractive in a low yield environment. In conclusion, the iShares 20+ year Treasury Bond ETF, or TLT, is a unique tool for investors who want exposure to long-term U.S. government bonds. While it's sensitive to interest rates and inflation, TLT can be a powerful way to hedge against stock market volatility, generate income, or position yourself from falling rates. So what will I be doing with TLT in my portfolio? I believe I'm going to switch out SPAXX, the 10,000 I have in there, for TLT in the coming day. Whenever the stock market opens, I'm going to actually purchase into TLT. It's down the past week or so, so I'm getting it at a lower cost than if I bought it a couple days ago. And I'm going to just hold that. And if it goes down, I'll just buy more. But for now, I'm just going to buy and hold TLT until it gets to roughly 150 or more. And then I'll go back into SPAXX or something similar. And that's kind of my plan. I'm just going to try and hold TLT and get a hold of those gains from interest rates going down in the near future, and continue to dollar cost average into it if the price continues to drop. If they decide to raise interest rates in the future, I'm just going to hold because eventually it'll go back up. It's just a matter of time. And if TLT does go back down, interest rates are going to go up most likely. So I'm going to try and take advantage of that and continue to hold TLT in my portfolio. So thanks for watching. If you found this video helpful, make sure to give it a thumbs up and subscribe for more content on ETFs, investing strategies, and market insights. Do you have any questions about TLT or how to use bonds in your portfolio? Drop them in the comments below. I love to hear your thoughts. Until next time, thanks for watching.